Hi, my name is Asif Suria. I'm an individual investor out of the San Francisco Bay Area who's been investing for 23 years, and I'm the author of the book, The Event-Driven Edge in Investing. In this video, I'm going to be talking about investment strategies and specifically about how you could expand your horizons to incorporate additional investment strategies. What we often find is that investors pigeonhole themselves into a specific idea or strategy. Some of them think of themselves as value investors, some of them think of themselves as growth investors, yet others are momentum investors, investing over very short time frames. What I'm trying to do with the book, The Event-Driven Edge in Investing, is help investors generate ideas through multiple investing strategies. And most of these strategies are going to be based on specific corporate actions. So, for example, a company insider buying or selling their own stock, a company deciding to buy back its own stock on the open market, or one company deciding to acquire another one. So each of these corporate actions can generate investing ideas that you can then look into further and do additional research on. Investing using event-driven strategies involves usually short time horizons if you use strategies like merger arbitrage, where one company is acquiring another company. But because this is an idea generation process, you could end up with ideas that could turn out to be long-term investments. Each of these strategies have their dark side, so I cover a part of the dark side in each chapter where something can go wrong with these strategies. And so understanding risk along with the return of an investment is critical. And each strategy is unique in terms of both the opportunities it provides as well as the risks you're going to encounter with these strategies. One of the ways you can stay informed with these strategies is to track filings with the Security and Exchange Commission or the SEC in the US. And you can find out within usually minutes which company insiders are buying their own stock or selling their own stock. Or if a company decides to acquire another company, they have to file a form with the SEC announcing the acquisition. So staying informed on these strategies is not particularly difficult, but it's important as an investor to do your work upfront and then to continue to follow the investment through its life cycle. The real magic starts to happen when you start seeing the same company show up across strategies. You might find that one company is acquiring a different company, and then the insiders of that company might also start acquiring stock on the open market. You might find that companies that are buying back their own stock also have insiders that are buying stock with their own money. So when you start seeing these companies pop up across the strategies, you start finding really interesting opportunities. Having a strategy, whether it comes to idea generation or whether it comes to how you want to diversify your portfolio, is very important. Some people focus on concentrated portfolios where they only have like 4 or 5 companies in their portfolio, which is what Charlie Munger and highly experienced investors often advocate. And what you get with that is uncorrelated returns from the market, where your portfolio could go up a lot, but it can also drop a lot because you are highly concentrated with just 4 or 5 positions. In contrast, for investors who are starting out, diversified portfolio of maybe 25 to 30 stocks makes a whole lot more sense, as long as those companies are from different sectors and you're not concentrated just in one sector or one country. So building a diversified portfolio can work really well for investors. And as your experience builds, you could potentially go to a more concentrated portfolio of maybe 10 stocks or even 5 stocks if you have so much confidence in the companies. Doing the work upfront is critical. Often you find that investors make a bet or decide to buy an investment without doing the work upfront, and then obsessively start to understand what the company does after the purchase. But if you do your work upfront, you will not only have the conviction to hold on to the investment when things aren't going well, but you will also be able to figure out what the intrinsic value of the company is and either add to your position or scale back on the position, depending on what's happening with the company. Thank you for watching. I'm Asif Suria, the author of The Event-Driven Edge in Investing.